stock does 20, it gets a return of, its alpha is 10. So it's the non-market related gains that you get out of something, which is what we're chasing. So they look to invest heavily into those sort of companies. And the other one are market neutral. And this is your market insensitive, where it doesn't really matter what the market's doing. They will look to make money out of it regardless of the movements of the market. And the fund I mentioned that Justin's a partner in the last week, they've made 4% on their money. That's the way they operate. They don't really care what the markets do. They have a team of 12 professionals. The big things that Ascalon does, it invests capital and seed capital into these funds. So it owns 20, 30, 40% of the capital and actually provides the seed money for their initial investments. They do the due diligence on the managers that they're looking at. They sit on the boards and they do a complete and continual review and due diligence on the performance of the funds. One of the major problems people have with these type of funds is the lack of understanding. And I can assure you, if you want an entertaining time, I'll bring a couple up and you can spend an hour or two with them. You'll retire hurt after about 10 minutes. Some of these guys are pretty switched on people, and a lot of it's mathematics. And in the end, you have to be able to get professionals' advice independent of the actual fund managers themselves. Now, I wouldn't be a good fund manager if I couldn't come and show you what they've done. This is actually some of the funds that Ascalon have with them, and they actually run a seed pool, and this is actually the stocks that are in that seed pool. Now, I won't go through all of that. Anyone after wants a copy of this, we can get you one. But what you're looking at there is the performance against its benchmark over basically since their various inceptions. 4, 6, 2.5, 5.3, 3.8, and then you got a couple of fairly amazing figures at the bottom. But these are genuine figures: 16.2 and a 28% absolute return. As I mentioned, Helix, which is the one that one of my directors runs, they've made 4% the last month. The last week. Now, others, like we take Regal at the bottom, its year-to-date performance is 12.6. The MSCI Global Index is 1.5. The big thing is, though, that they can return good, steady results, but these funds rarely have a negative return. The other one is a more traditional business, Advanced Asset Management. Again, it's a fund manager that focuses on asset allocation and uses the manager of managers approach. They cover a universe of about 700 funds globally, to which they invest in, and they cover all traditional asset classes, excluding property. I've been around this industry for quite a while. I met these guys the first time about 4 or 5 months ago, spent a few days with them, and I'd have to say the work and the way they go about it is one of the best I've seen in that time. As we go forward, where we're giving asset allocation advice, we will spend a lot of that time working with these guys to come up with it. The other part of what they're doing, apart from the strategic asset allocation, is a tactical overlay. So they start off with a base portfolio, then they will alter that according to the short-term changes that they foresee. And that is a particular value which then would be added to the funds that they're looking for. As I said earlier on, they can access the fees significantly better than what's available to any normal investor trying to get into these funds. And the research and the work that they're doing on these, I have been very, very impressed with. This is a very quick sort of look at the process they go through in the multi-manager. I think it's important because you can actually see how they go through it. They set the objectives of the client, so they work that out with the client. They do the asset allocation modelling. They then look at the various sector structuring within it, and then on to manager selection. They then look at those managers and then blend them for their various characteristics to get the optimal structure of the investment, and then it's monitoring and reviewing. It's a very structured process, and that gives them the sort of results which is, say, as you know, noticed Patrick awarded just a couple of weeks ago Fund Manager of the Year in Australia. The next one, a little more complicated. In selecting the managers, as you run down the inverted pyramid, the manager universe, the screening, due diligence, preferred managers, blend analysis and selection. They use both quantitative and qualitative factors in coming up with their selections. As I said, one of my things is I like to try and come up with a thought or an idea which might provoke some interest. Interestingly enough, I've heard one or two references to the word today, but this is going to look at, where I'm looking at here is infrastructure. And I think an area for concern for the superannuation industry right around the world. And in a sense, what I'm saying here is that the biggest financial issue in the world today is the size of public debt. It's where, particularly over recent weeks, the problems have become pretty stunning, and no one seems to have any particular ideas of where to go with that at the moment. Public debt in many countries is nearing the size of its GDP, and the world's pension funds in a lot of countries are nearly as big as their GDP. And when I say it hasn't been lost on government, if by any chance anyone's a student of politics in Australia, the ALP conferences for about the last 10 years have had regular sessions on how they can rip the money out of the superannuation industry and get it into the government's coffers. And that's about as blank as it's bland as it's been in the way they've phrased it. And I'm sure this is true everywhere. Just to put some figures on these are the actual numbers, which I was a bit surprised at when I went looking for them the other day. But you can see from that there is an amazing similarity between pension assets and the debt position amongst the leading countries in the world. You know, this morning the Governor said that 35%, I think, was the debt position here, which is good. I honestly don't know how. Do you know, Ian, how the pension funds here relate to GDP in size? What's the GDP? I should know.
I think there were some statistics mentioned by the Governor.
He mentioned 6 billion of the 35% debt to GDP and 6 billion funds, but I'm not sure what the size of GDP is. I should have looked. But anyway, I should have had that one added in. The question, I guess, which I could throw to you guys is, has this been lost on government? And the answer would be very much no. It hasn't been lost. An infrastructure fund or bond would be a very easy political sell, and it could have a quite significant impact on the budget deficit reduction globally. And this is more my own view, but world government track record on delivering major projects, I think Paul's being kind to them. I certainly wouldn't want any of my money being managed by the government. Unfortunately, quite a lot of it is. And if we go on to, if you like, what action we can take, what I'd say is should the super industry act to undertake infrastructure investment that make commercial sense, correctly costed and delivered on time and budget, and a strong statement of social responsibility, which ironically is one of the objectives of this forum. The other issue I would just address here as well is that infrastructure funds are not a new thing. They're quite common around the world these days. What most of them are super funds that buy into projects once they've been developed. If it's a road, they buy into the income stream that's been developed. So they're not actually developing infrastructure, they're buying the assets to pick up the cash flows. Now that's fine as an investment, but it actually doesn't do a hell of a lot unless it's freeing up capital to the government. Normally, they're buying these off the developers, off the construction companies. So they're not necessarily pushing that money back into the community. I think one of the things that really can be done nationally, even possibly regional, although that obviously would have some interesting political discussions, to ensure the maximum leverage for investors and the delivery on successful developments. Clearly, social security, and when it starts to get the money into its coffers in PNG, the sovereign wealth funds could also be quite strong participants. So one thing I think could be an interesting area would be for the industry to make some sort of assessment of this and say it's prepared to put 5–10% of its assets into properly structured and run infrastructure projects. By chance, just recently, first time I met Ian, actually, we had lunch, or we bumped into the general manager or the CEO of New Guinea Power, it's called, PNG Power, sorry. And I was asking him questions and chatting about there, and all he could talk about was how he just can't get enough money to make sure that we don't have power blackouts all the time, which we are having here. But he can't access those funds. And I'm quite sure if I talk to a lot of people operating in similar areas, we'd have similar type comments. So I think it's something that I feel that there is a major role that this industry can play, not just here but around the world. And maybe the times, given the events of recent times and government problems, before the government takes it out of our hands, the industry starts to look for it. And that's all I'd like to say at the moment, and thanks for your attention. Cheers.